Hi, this is the fourth part of basic budgeting on Excel. In this part, we will talk about the concept of variance that we a little bit discussed in the last part. And we will talk about different types of variances like price versus cost or volume variance. And then we are going to talk about how we can analyze these variances. So the term for variance means that different things in different concepts. In general, it represents some types of difference between something. In accounting literature, variance stands for the difference between your target, so budget figures in our case in this course, and the actual result. There are two types of variance: price or cost variance and volume variance. To know this difference is important to identify the reasons for the variance so we can improve our budgets for future. Well, in accounting, for all of the businesses actually, the price variance is the difference between the planned unit price and the actual price. So simply, we have no control about the price changes. For example, if you're manufacturing something, we have no control over the prices of the raw materials. However, if there is an expectation for a price increase, you can always inventory more. And well, in a similar way, the cost variance means that difference between the planned unit cost of any resources that we will be consuming and actual unit cost. So simply it refers to the cost items, and the blue one, the price variance refers to the planned unit price if you're selling something. Well, the most important part in this scenario is that how your income will be affected. For example, if there is a salary increase, the positive variance, we call it favorable variance. The favorable variance is not going to be your success actually because it's going to be based on the salary increase. Again, the cost, in terms of the cost variance, if there is an increase in the price of the resources that you're consuming, so simply this is not your fault, and basically we cannot keep budgeting the same cost over and over with the previous price. For example, if there is any price increase in the price of 1 liter of gasoline, so the gasoline expense that we will be having will be greater than our plan, even though we exactly use the same volume that we predicted, let's say 100 liter. And if this is the case, simply it means that there is an outside effect on the budget. So then it requires us to run a more detailed analysis for the external environment. As I said before, we are not in perfect isolation of the environment that we have been surrounded by. Therefore, we need to also keep track of observing the environment as well for the price increasing, for the currency changes, and so on. Well, as a difference between volume variance and price or cost variance simply is that volume variance is the amount of volume is the amount of resources that you consume, or if you are selling something, simply the volume difference will be amount of sales, let's say number of units, not the dollar amount or not the monetary amount. In case of a revenue or income variance, volume variance represents the difference between actual quantity of the items that you're selling and on your budgets and your actual results. In terms of cost, it represents simply the difference between the actual amount of resources that we use and what we planned for that resource. This is the variance that we can always the direct control over. So simply we can control over the number of, I don't know, the resources that you can use. It might be anything like, say, let's say electricity that you're using in your house is going to be up to you. Well, to save some money, it doesn't require you to actually shut all of the lights off. However, to manage it or to precisely predict what will be that cost in next month. Variance analysis refers to some set of analysis of differences between actual results and the plan. So we are analyzing the variance. The sum of the variances represents the overall over or underperformance information. However, if we go step by step or item by item, we can actually evaluate our performance on specific budget items. Usually what we do is that on the Excel, one column for budget and another one for actual results that I showed you earlier. Then for each line, we are going to be deducting the actual figures from the of the respective line from the budget figures to see for the variance, to look for the variance. Simply as in here. So, on the difference side, all I did was deducting the actual result from the projection. This is, actually, you can also do the reverse, deduct projected cost from the actual cost. However, in that case, because these are the cost items, we are trying to capture where we were off. That's why actually we are deducting from the actual results from the budgeted cost. In here, as you see, in total, we have $41 unfavorable variance. Simply when we talk about favorable or unfavorable, we mean that if it is increasing our net income, we call it favorable. Or on the other side, if it is decreasing our net income, we call it unfavorable. So in our budget, if we look only the totals, we will see that we were off by $41. However, if you look more detailing on the difference column, we will see that there is a $23 favorable variance in here for maintenance. So simply we projected for some maintenance use. However, we didn't use any of it. So simply there is a favorable variance actually. If we don't have that variance over here, it will be 41 plus 23. Simply in here, as you see, on the phone, electricity and gas, we have unfavorable variances. Well, as I said before, one important point is that our budget table should not change from one month to another one. So simply we can copy and paste the items to the next month, as you see in here. We can, after this is going to help us actually if you have some total sheet, you can simply copy the, the balances of each month. Also, another important part is that on the left side, we have a detailed budget. This is important to analyze each month so we can improve the next month's budgets as well as our actual results. However, it is also important to have a summary table as well. That's why actually in here we have two different sides. On left side, I have the cost items. On the top of the sheet, you see the total projected cost, total actual cost. So this part is for my cost. On the right side, at the top, I have projected monthly income. Then I have actual income. And at the very bottom side on the right, you will see the actual balance. So simply, this balance is going to give us what I have as a remaining, well, after I spend my money, and what is the total amount of the variance that I have. In the first months, it is not going to mean much to you when you start budgeting, because simply you have no, well, background information from your previous months. However, if you keep doing the same, using the same budgeting style and keep budgeting every month, you will see the areas that you can improve yourself. That's why it is important to have a detailed budget and also a summary one, because simply if you add a tab for the cumulative budget amounts for the year, for example, you will see how it is going to be coming over the time. And also next year, when you, well, if you are expecting for some seasonal changes, so you can always, for example, if you're in January, you can always go back to look at last year January budget to see what type of resources that you use. So you can predict that, okay, this is going to be similar, or depending on maybe inflation, you're going to be increasing the amount of your cost, but you're going to be adjusting your cost based on inflation rate, so you can have the new items again. And this is it for this part. And the next part, we will talk about how we are going to be actually converting our budgets to graph to see a bigger picture in terms of how we did in terms of financials. Thanks for participating.